UK dominated headlines again over the month, with the resignation of Kwasi Kwarteng, the Chancellor of Exchequer, as well as the Prime Minister Liz Truss. So it does make Liz Truss the shortest serving PM in history, lasting just 44 days. However, their subsequent appointments, with Jeremy Hunt coming in as the Chancellor of Exchequer, as well as Rishi Sunak as the new Prime Minister, did restore confidence back to the market, as we saw with the decline in credit default swap spreads, likely due to increased perceptions of more fiscal prudence taking place. Markets remain extremely volatile. So we did see a counter-trend bounce in equities over the month, so they did rebound quite sharply, although the fundamentals continue to deteriorate into a slowing global economy, with liquidity getting thinner and thinner by the day. With regards to bond yield movements, over the last couple of months, we've seen bond yields increase in an unprecedented fashion, which have also affected mortgage rates. Thankfully, we are starting to see housing price appreciation in the developed market pace slow, so this should be very good for inflation heading into 2023. However, we are getting closer and closer to a point where central banks will need to strike a fine balance between restoring the growth backdrop to a more normalized state, as well as quelling the inflation trajectory. While US headline inflation continued on its mild disinflation trajectory, core inflation continues to accelerate, so that is stripping out your more volatile components such as food and energy, and that actually came in at 6.6% year on year. So that is in fact the highest rate since 1982. So this will almost certainly embolden the Federal Reserve to tighten monetary policy much further in the coming months, and we will continue to assess the overall inflationary impact of the highly volatile movements such as oil. More recently, we did see OPEC cut 2 million barrels per day of supply from the oil markets, and we'll need to continue to monitor oil prices quite closely given the high volatility. Also, given the policy dilemma in the US in terms of drawing down on the strategic petroleum reserves, providing little respite to the market, we will continue to monitor markets' reaction thereof, but one thing that we think is going to prevail in the coming months is that volatility is certainly going to be the status quo. So while the dollar weakened somewhat in October, on a longer term basis, the greenback continues to be supported by higher bond yields, a slowdown in the global economy, and draining liquidity from the financial system. More recently, however, we think bond yields movements have largely been attributed to the selling down in treasuries by major foreign holders such as Japan and China into a highly illiquid market. So going forward, we think that financial conditions will continue to be tightened meaningfully, and that will likely start to increase intraday volatility in bonds, currencies, and equities. Xi Jinping in China maintained a third term as head of the Communist Party. And reviewing some of the high-frequency data out of China, we saw GDP release for the third quarter, so that came in at 3.9% quarter-on-quarter, so that was above Bloomberg consensus expectations of 2.8%. But ultimately going forward, the unwavering approach to lockdown restrictions unfortunately filtered through to future earnings prospects in terms of the discount that investors are perceiving in terms of the growth that some of these companies will realize. Hence the lackluster performance in the Chinese stock market over the month and over the last several months. So going forward, these stocks are starting to look quite cheap. However, we are still waiting for a potential catalyst for these stocks to potentially re-rate. So we will be looking for opportunities given that valuation is becoming compelling. However, we think that a catalyst will need to be in place first. Heading into 2023, we think that market conditions will likely remain volatile. However, with volatility, that creates opportunity, so we will be looking to preserve our investment capital and also to capitalize on some of the opportunities that head into 2023. So some of the main themes that we will be looking out for is the confirmatory backdrop of disinflationary trends emerging and what the central bank response will be, which will have a meaningful impact on asset market directionality going forward.